I didn't really follow.
Okay, well then let's maybe you can follow this more closely, because it's something that I know you will have a strong opinion on. A lot of people are wondering about QE, if there's going to be a QE3. You have people reading the tea leaves with every Fed governor's comments that have come out. William Dudley said something about it today. Surely you don't think that more QE would be a good thing, Mike? Would ya?
No, I do not, and I guess it's something that we agree on, Lauren, and here's why. QE really functions like a tax, and the reason that's true is because it removes interest income from the private sector. Think about it. When the Fed conducts QE, what happens? It strips the public of one asset, which is a bond, and it replaces it with cash, a reserve balance in the banking system, which pays nothing. So you have the removal of a very significant amount of income. That's the same thing as a tax. What is a tax? Why do we hate taxes? Because they take income away from us. QE does exactly the same thing. Last year, the Federal Reserve handed over $80 billion in interest income to the Treasury. That's income that would have been earned by the private sector. And over the past 4 years, $400 billion has been taken out. That's not an insignificant amount of income. So, and the proof is in the pudding, right? I mean, we've had all this QE, and the economy is still only growing at 2%. So I would say absolutely they shouldn't.
So in that regard, is the Fed messing with the space and time continuum, and could this be leading to a cosmic, explosive destruction in the economy, Mike?
Well, no, I don't think so, and I think it gets back to what I said at the beginning was, remember, it's double entry accounting, so if it's taking income away from somebody, a saver, let's say, it's providing income to somebody else in the form of, let's say, lower debt service payments. The problem is there's a leakage there. It goes into the banking system in the form of higher margins and profits. So net, I think it's a negative. Net,
negative. When we come back, I want to talk about Europe, because that's a biggie, and we're going to want to talk about what's going on there. We will have more with Mike Norman, chief economist at John Thomas Financial, after the break. And still ahead, forget the space-time continuum and even flights to outer space for that matter. It seems Sir Richard Branson has other ambitions these days. We'll give you our 3 cents on. Welcome back. So Europe has tried to paper over its problems. We've seen that despite the fact that a debt crisis persists. The ECB has pumped liquidity into banks. We've seen more than $1 trillion pumped in through LTRO. Yet again, we see Spanish yields have been rising. Some concerns there. Christine Lagarde, managing director of the IMF, today said Europe is the threat to the financial stability of the global economy still and is no way out of the woods. George Soros writes in an op-ed about Europe that the fundamental problems have not been resolved. Indeed, the gap between creditor and debtor countries continues to widen. The crisis has entered what may be a less volatile but perhaps more lethal phase. Now, regardless of the motivations for what they're saying, okay, we know Lagarde is trying to raise money. I think George Soros has plans and ideas of his own. But the problems that they talk about, that is very clear. It goes to show that you can try to paper over a problem, but that doesn't make it go away. So what are you to do? That's my question as we continue with Mike Norman, chief economist at John Thomas Financial. So, Mike, my question is, we've seen so much liquidity pumped into Europe. Okay, they still have a debt crisis. They still have all of these problems. What is the solution to that?
Okay, well, that's a hard question,
that is
but I'm going to answer that. But I'm going to answer that. In George Soros' article, by the way, he said he didn't have an answer. I'm going to give an answer. First of all, you have to understand one thing. The liquidity that was pumped in were loans. And the problem with Europe right now is that all these countries, and we have to remember, very important to state, that none of these countries are currency issuers anymore. They're like functionally like states in the United States, so they can go bankrupt. So these loans on top of loans to countries whose economies are contracting as a result of austerity, there's no way they could pay them back, right? I mean, the math just doesn't work in this situation. We know that, what the problem is. Now, the solution is to have a fiscal authority, but they don't have a fiscal authority. It's not like the United States. If California was going bankrupt, if push comes to shove, the federal government could give money to California. You don't have that in place. What you have in Europe is the ECB, which could be like a fiscal authority, and it kind of has been acting like that in the purchase of bonds. It's been sort of quasi-funding these countries like Greece and Spain. What you need to have is for that to be institutionalized. Right now in the European Constitution, that can't really happen. So they're figuring out all kind of ways that the ECB could kind of do that, and Germany's against that. But to really solve the problem, what you need to have is for the ECB not to lend, but to give a distribution, maybe let's say 10% of your GDP to all countries, not just Greece, so there's not everybody all, upset that it's just going to Greece. 10% of GDP, a one-time distribution, or maybe repeat that the next year if it's necessary, to allow the deficits to remain at the current level so that they could stop all the gutting of their economy so that the economies can stabilize, start to produce revenue again, hopefully get back to a growth path, and then those deficits would start to shrink.
So, Mike, are you saying give them money? Give countries money? Give banks money? Give who money?
Give them. The ECB gives a 10% distribution to all the Eurozone members. Give them money.
Okay, so then in this scenario, what would the members do with them? Because the whole issue is the banking system, and we've seen the ECB at least try to prop up banks. But one of the big issues there is that money, it maybe averts a credit crisis, but the banks don't lend it, and they don't buy sovereign debt with it. They just use it to shore up their balance sheets.
Right. Well, here's what happens. And I went over the problem with the other way they're doing it, because it's just a loan on top of a loan. The money forestalls or stops the collapse in economic growth. There's only one way to pay back the banks, Lauren, and that the banks are businesses, right? They made loans. That's their business. The loans get paid back if you have economic activity where people have jobs and they're making money and they could pay back the loans. This is the whole problem. Where austerity is not allowing this to happen. If you stabilize the economies, so you don't have to lay off millions and millions of people, and you don't have to close firms, and business could start to grow a little bit, guess what? The loans get paid back, the banking system starts to heal, and you grow your way out of it. That's the only way. If you continue with these loans, if you continue with the current approach, the so-called remedy that they're going after, it's an absolute 100% guarantee that the whole thing is going down. And I will say this, the strong nations like Germany, who think they're now shielded from this or in some way protected because they're very strong financially, the whole thing will migrate right up to the top. It'll get to them too. Why? Because Germany is literally killing its customers, that is the periphery and the other nations in the Eurozone that buy their exports. So if they don't see this, it's amazing that they don't see this, and I've said it before on this show, it's the definition of insanity, continuing to do the same thing over and over again and expecting a different result.
The one question I have, though, is how do you know that you're going to maintain faith in the currency if you just give all these governments a bunch of cash?
Well, are you maintaining faith? Yeah, I'll just answer your question with a question. Are you maintaining faith in the currency by destroying your economy? Come on.
Well, either way, it doesn't seem like either one wins. It seems like you could lose either way.
Well, I disagree. I think if the economy grows and people are working again and things stabilize, I think the currency at least stays stable. I'm not saying it's going to go up through the roof, but at least it stays stable.
All right. Well,
that would be my guess.
Okay. Well, good guess, and I appreciate you being on the show. We're going to have to leave it there for today. That was Mike Norman, Chief Economist at John Thomas Financial.